Hey everybody, Don Fishback here, and today we are going to talk about day trading options. Who wrote this? All right, we're back, and so today we're going to talk about day trading options. And James, I've never talked about Terry. I've never talked about day trading options, right? So why would I start day trading options? Well, one reason is because of the risk, but the other reason is because that's what the market's giving us. So I'm going to talk a little bit about volatility term structure and why that applies to day trading options. So the volatility term structure, let's just draw a little graph right here. This is going to be the implied volatility, and then this is going to be the time to expiration. And so what we're going to do, these are going to be real short-term options, maybe 2 days, and this might be 1 week, and 1 month, and 2 months, and 3 months, and 4 months, and so on and so forth, right? Well, what we found is that in most instances, the volatility is going to be this. Let's say this is 10%, and then this is 20, and 30, and 40, and so on and so forth. And so this goes on up to 60. Oh, I'm a little bit too high probably. So that's all right. Okay, and so about 60. All right, so what we can do is we can draw the implied volatilities of the options at these different terms. So normally, implied volatility looks what we call, it's a normal curve, a term structure curve. And so let's say the implied volatility of the short-term options might be about 15, and the 1 week might be about 16, and the 1 month might be about 18, and the 2 month about 18 and a half, and so on and so forth. And so you get the implied volatility of the options at these different terms, and it creates what's called a volatility term structure. And so this is what we would call normal. Markets are almost always like that. And if you think about this, your objective is to buy low and sell high. Well, you want to buy low, right? So this would be the buy area right here. And then out here, this would be the sell because this is high. And you want to sell that. Now that's assuming everything else being equal. This is what you would want to do if you were just looking at the implied volatility to make your decision. What one researcher has found, and we've been able to confirm this, is that when the term structure is like this, straddles are a good investment. So that's one thing, and we've been able to confirm that. But that's not the way the market is right now. And the market is doing something really unusual. And so I'm going to get rid of this right here. So this is the normal curve, term structure curve. What we've got now is something completely different. So the long-term options actually have implied volatilities that are down around here. And the short-term options have implied volatilities that are way up here. And it looks something like this. And remember, what our objective is to buy low, or, because we can do this, we can sell options first and buy them back later, or sell high. Well, what is high on this chart? Right here, which is the real short-term duration options. So we're talking about a day or 2 days, 3 days at the most. So that kind of tells us where we want to be, where we want to be looking for our trades. We want to be looking for trades in this real high volatility, real short term. And there's another advantage to that. It's hard to predict what's going to happen in a month, right? I have no idea. None of the people, I mean, the president has no idea. His advisors have no idea. His competitors, they have no idea. So if nobody has any idea, this is really just a guess, but we can get compensated for this uncertainty because the prices are so high. So that's why I'm willing to take a trade that only has a teeny tiny amount of time, whether it's 1 day, 2 days, or 3 days. So again, looking to day trade options. So this tells me what I want to do. I want to sell high, and so I want to sell this is volatility, right? So if you want to sell implied volatility, the way to do that, to reduce your margin and to limit your risk, is through a credit spread, where you sell an option and you buy one further out of the money. So that's what we're going to do. And so I've asked my beautiful assistant, Terry, to help me here. She's got her computer going, and she's going to give me some numbers here. Terry, where did S&P, we're looking at SPY. Where did SPY finish? Where did it finish last night?
251.83.
Okay, let me write that down. So I don't need all this stuff right now. All right. So SPY finished at 251. What'd you say?
83.
83. Okay. So that's the first step, is finding out where the SPY is. The next step is I look at delta. And for anybody that's follows this stuff, to get a good idea, it's not exact, but to get a reasonably close idea of what the market thinks in terms of what's the probability that a strike price is going to be met, you can just look at delta. So Terry, I want a trade with a 90% probability of being out of the money, or only a 10% chance of being in the money. And so I'm going to look for a delta of about 10%. So where would that be?
That would be the...
And so we're looking at, so today is Friday, we're looking at Monday, so that's April 6, 2020. Okay, so what's the one, so just you go down the option chain until you get to a strike price where the delta is less than 10%.
Okay,
the first one.
The 233.
So 233. Okay, so now this is just a little quirk of me being in the business long enough. I like to sell spreads that are 3 points wide. James, you like to do them about 2 points or 1 point wide. Yeah, okay. I like to do it 3 points wide. So that would mean that I would sell the 233 and buy the 230. Well, one thing I know about the options market is that those round numbers like the 240, 235, 230, 225, and 220, those options are going to have the highest volume. They're going to have because people want to buy those. So if there's a lot of buying at those strike prices, that means the price might be jacked up a little bit. So I do not want to do where I sell the 233 and buy the 230. I don't want to do that. So what I'll do is I'll just go one strike price further out, and I will sell the 232 put. Oh, 232 put. Let me fix that. Let me write this down. Let me try this a little bit. I'll sell the 232 put, and I'll buy the 229 put. And so now I've got the asset is SPY, and the expiration, I've got the strike prices. Now all I need is the right price. So the price, I'm going to use our software I'm going to ask my lovely assistant to use the software, and we're going to stress test this. We're going to stress test it, and we're going to look back for periods that were similar to this, not identical to it, but similar to it. And so that's going to be the period of the financial crisis, and it's also going to be the action that we had the last month. So our software can say, only look for situations where there was absolute chaos. And the software will look for that chaotic period and then say, this is what the price needs to be based on that chaotic period. And so Terry, what were the prices for this right here, the 232 put? That is FOV, IV in the software.
Okay, the 232 put is 0.76.
Okay.
And the 229 is 0.48.
Okay, so I'm gonna sell this one, so it's a credit to my account, and I'm gonna buy that one, so it's a debit to my account. So that equals, I'm gonna do it for 0.28. So that's the price, right there. So now I've got everything I need. I've got the asset, I've got the expiration series, I've got the strike prices, and I've got the price. Everything I need to do this. So that's it. Real simple. And then we put this thing on, and I think SPY has come down a little bit since this morning. So question is, are we going to get filled on this? Because I'm looking at this. I'm not even looking at the prices right now in the market. I just put this order in on a good till canceled, and we'll see if we get filled. But that's how to either 2-day trade or 1-day trade. You just go through that process, choose your asset, choose your expiration date, choose the strikes using delta, and then use FOVIV to get the price. And we're doing this because of that chart that I showed you originally, because of the volatility term structure. So thanks for watching. Hope you enjoyed it and learned something. And be sure to hit that subscribe button. That way you'll be notified as soon as we post these things. So thanks for watching and have a great day.